A merger can look strongest on paper the moment it begins to fail in practice. The financial models stay polished. The projections stay confident. Yet beneath them, a slow divergence starts to form. Small at first, then structural. The insight arrives later. Some mergers peak early. Others unravel quietly over a decade. And in food and beverage, those reversals often happen long after the synergies have already been spent. Most large deals begin with bold numbers, billions in expected revenue, cost savings measured in the hundreds of millions, integration plans mapped over 3 to 5 years. The early results often look strong. Procurement consolidates. Manufacturing lines tighten. Shared distribution reduces redundant routes. Synergy targets typically hit their peak by year 3. But that curve flattens fast. Once the obvious efficiencies are captured, the merged company must rely on underlying category strength. And that's where the paradox begins. When Kraft and Mondelez separated after years under one roof, the reasoning was clear in the filings. Growth expectations diverged. One business sat in slow-moving center store categories. The other was expanding into snacks, with mid-single-digit global demand. Keeping them together, compressed valuation, and limited capital allocation. A similar pattern reappeared when Kellogg later divided its businesses into cereals and snacks. The cereal division had endured a decade-long volume decline, while the snack side grew through portable, higher-margin formats. A single company carrying both segments created strategic tension. Investment flowed unevenly, and category economics pulled in opposite directions. These reversals share a mechanism. A merger begins as a story of scale, slight rise, but ends as a story of divergence. Markets evolve, often faster than integrated companies can adjust. A division with early momentum may stagnate. A brand portfolio built for a single consumer profile begins to fragment. And categories that once delivered steady cash flow shift into low growth patterns, dragging against faster parts of the business. Meanwhile, integration carries its own cost of ownership. Manufacturing footprints don't realign instantly. IT systems remain mismatched for years. Logistics networks, designed for 2 separate businesses, take time and capital to consolidate. These frictions rarely appear on earnings calls, but they quietly erode margin. Even a 1% efficiency gap on a multi-billion-dollar revenue base can mean tens of millions in lost value annually. Once this integration debt builds, reversing a merger starts to look less like an admission of failure and more like strategic correction. There is also the pressure of capital markets. Investors increasingly reward focus. Pure-play snack companies often trade at higher multiples than diversified packaged food conglomerates. Beverage leaders, built around fewer, faster-growing categories, sometimes carry valuation premiums that broad portfolios struggle to match. When a merger reverses, the market reacts quickly. Breakups can add 5 to 15% to the combined valuation within days. The reason is mathematical. Each entity can now pursue a strategy aligned with its category's growth curve, not the average pace of the portfolio. Look across the past decade, and the pattern repeats. Companies split when the cost of keeping slow and fast categories under one roof becomes greater than the benefit of shared scale. Margin expectations diverge. Innovation cycles diverge. And eventually, the capabilities needed to grow one division begin to hinder the other. The most striking example of this came from businesses where manufacturing complexity intensified after the merger. Integrating distinct production systems often required capital far beyond initial projections. What began as a plan to consolidate plants and upgrade lines turned into multi-year investments with mid-9-figure budgets. As costs rose, synergy logic weakened. Over time, these pressures compound into a strategic conclusion. The structure built a decade earlier no longer fits the market. Reversing a merger, then, becomes an act of modernization. It lets a legacy division focus on efficiency, while a growth-oriented business reallocates capital toward innovation, expansion, and premium segments. It uncovers valuation hidden beneath the complexity of holding both under a single corporate umbrella. And it reflects a deeper shift in how food companies compete. Scale, once delivered advantage. Today, speed delivers advantage. Agility delivers advantage. Focus delivers advantage. So when a company unwinds a merger 10 years after signing it, the move often says less about the past and more about the future it needs to build. The question now is how many more companies will confront the same crossroads? How many portfolios still carry categories that no longer move together? How many growth stories are trapped beneath legacy structures built for a market that has since shifted? Because in modern food strategy, the real power doesn't come from holding everything. It comes from knowing exactly what no longer belongs.